Good morning, Market Chameleons, and everyone joining us for the first time. Thanks for coming by and checking out the Market Chameleon pre-market show with this man, Dimitri Pargamanik. How you doing, D?
Good morning, Will. How are you?
Great. You want to start with the disclaimer?
Yep. Good morning, everyone. Before we get started, keep in mind Will and I and Market Chameleon, we're not a registered investment advisor. We're not a broker-dealer. We're not telling you what to do. We're just sharing ideas. If you need advice, call your registered investment advisor. Call your broker. That's what they're there for. There's a disclaimer. I'm going to share my screen. And if you're joining us for the first time, Will and I, we do these shows in the morning to try to help answer questions you may have about the Market Chameleon tools, the data, the analytics. If you have a question, type it into that live chat on YouTube. Will's watching it. He'll read it back to me. To give you guys a couple minutes to put in those questions, what we'll do is start out taking a look at the pre-market report, see if we could get insights on what's going on in the pre-market hours, and then we'll move on to the questions. All right, so let's start with the pre-market report. These are stocks that trade in the pre-market hours. Up top, we have a calendar view. It does allow you to go back in time and history if you want to check out what happened in the pre-market on historical dates. Right now, we're on November 28th. So far, this is what's going on. We got 387 stocks up in the pre-market hours, 323 stocks that are lower. As far as volume goes, we got 102 million shares trading on up volume, 67.7 million shares trading on down volume. If we convert that volume to notional or dollar value, we have $1.2 billion worth of stock trading higher versus $1.3 billion worth of stock trading lower. So from just that alone, I think it's a mixed bag in a pre-market. We can't really say we have a strong indication that trading in a pre-market is, leaning more bullish or bearish. So far, pretty much a mixed bag looking at those numbers. So we'll take a look at it from a couple more angles, and then we'll move on to the questions. I'm going to scroll down here. Our next report has a list of the most active stocks in the pre-market hours, the biggest percentage gainers, and the biggest percentage decliners. Here we see 37 stocks made our percentage gainers list, biggest percentage gainers, 19 on the decliners. So that indicates a little bit more of a bullish bias at the open. Now, to make this list, we do have thresholds in there regarding liquidity, volume, the price change in the pre-market hours. But to make this list, it could be any stock that's listed on a major U.S. exchange. So there are small cap stocks in there, ETFs, leverage products. To narrow down this list to a smaller group of stocks, we could use the filters above. And we're going to, if you have a watch list, you can filter by your watch list. We're going to use this filter in ETF. As an example, I'm going to click on it. You see different ETFs to choose from. We're going to select this one, SPY, which is the S&P 500 ETF. When you do that, the list below gets filtered by stocks that are holdings in the SPY ETF. So based on our thresholds, 2 made our biggest percentage gainers list. We don't have any on our decliners list. So a little bit more, I guess, towards the bullish side. But again, lists are small, doesn't look like overwhelmingly one way or the other. And I think that just in general, the end of the November months, because of the holidays, tend to be slower, right? Things kind of slow down, volume slow down, volatility slows down. We just had the Thanksgiving, and as we get closer to the New Year and the holidays, those typically also periods that things slow down. We gave it a couple minutes. Well, if you have questions, I'll take them now.
No questions. I don't know if you want to look at a payout diagram. Mike threw out to the crowd. He's looking at a vertical spread, a Jan
Okay.
19 expiration,
Okay.
the 2017 for credit.
Which stock is that?
It's PLTR, Palantir. It's one of those AI. I mean, it's one of those early AI companies that has had a nice rally off its lows, but it's a PLTR.
Okay.
And it's the vertical put spread 2017 for a credit, Jan 19 expiration.
So Jan,
again, he didn't ask for anything in particular. He was just mentioning that something he's looking at.
So Jan 19 expiration. What was the put spread?
It was the 2017 put spread.
2017. Okay. For credit.
Yep.
All right. So let's just take a look at that. We're on January 19th. Right. This is Palantir. We have 36 trading days to go, 53 calendar days for Palantir. And the spread is a credit put spread. So we're going to look at selling the Jan 20 put. All right, so I'm going to click on that bid Jan 20 put. So it brings up a sell Jan 20 put ticket for $1.92, where that's the last bid price. Then let's come up here and buy the 17 put. All right, so here's a 17 put for 61 cents. So here we have both legs of the strategy: selling the 20 put, buying the Jan 1917 put for 61 cents. And if we calculate that, we're going to get a payout diagram at expiration. So let's come down here. And this is how the graph of the payout diagram looks like. So here we see these are the different stock prices at expiration. And over here, this would be the P&L, or what the strategy would return at expiration on these stock prices. So here we get a credit of $1.31, right, by selling this at the current prices, 192.61. You can see here that the spread is pretty tight, 2 cents wide, midpoint 132. So what happens if the stock is right here at expiration? That's this line right here, 1909. So this line here is where the last price is. So you could see here that if we close exactly at this price, then this spread will, even though it's below, right, the 20 strike, even though, 1910 is below the 20 strike. So this 20 put is in the money, right? But even though it's below the 20 strike, since we received $1.31 credit, if it trades here at 1910, this will still be profitable, right? Because it's only in the money by 90 cents. We received $1.31 credit. So you can see that would be $41 gain. So assuming you could, just get out at parity or sell the stock or whatever, that's what the value of that spread will be. It'll be a $41 gain for that spread. And you got a little bit of more cushion to the downside, right at the break even for that, because of that credit that you received. And if the stock drifts, right, your sweet spot is right above 20. So once it goes above 20, that means both of those puts will expire worthless, and you will keep that entire credit that you received for selling the put spread. And let's say the stock just drops and goes down and you were wrong. And of course, this is, all trades have some risk in it, right? There's inherent risk. This is, you could see from this graph where your risk is. So the risk is that the stock goes down, but you are stopped out because you did a put spread. So if it just falls below 17, you can see here, this is your break even here. So you do start losing below that break even point right there. But you're stopped out once it reaches below 17, you'll hit your max loss. And then even though it keeps going lower, you're stopped out from further losses. So you could see there that if you're really wrong and this stock collapses or has a very violent or drastic move to the downside, the good part is that on this type of strategy, you defined your risk ahead of time, you limited your risk. You're not, grappling with, what you should do at that point. You're stopped out. All right. So that's the good part about doing these vertical spreads. So that's what the payout diagram looks like. And up here in Greeks, here's your initial risks. So this will calculate the initial risks of the option strategy. You could see that it's long delta, right? That's not a surprise because you're selling a put spread, you're bullish. So initially you're long 30.9 delta, meaning that if the stock from this point moves up $1 or down $1, without, other variables moving, time decay, implied volatility, nothing like that. If all the other variables stay constant, if the stock moves up $1, this spread will make $30.90. That's the expectation. If it's down $1, it'll lose $30.90. That's the delta. The gamma is negative 2.9. Your vega is negative 0.6. And this is your theta and rho. All right, so these are your initial risks up here. That's how, if you were trading your positions and you're looking at the different risks of this strategy, how to manage it, those are your initial risks, right? Before you do anything. And this would be what the spread looks like at expiration if you did nothing, just held it, and based on where these stock prices are. So then, we could analyze it a little bit further. Now that we know the risk and reward of the strategy, we could visualize the risk and reward. We could visually even see if that is lines up with our long-term outlook, right? Does this line up with your long-term? If you're bullish on Palantir, but you think that it does, that you're bullish but not super bullish, you think that it will rise, let's say, a very good chance you think that it's going to go up 10% in the next month, right? In this 53 days or 2 months to go, whatever it is. So if that's your target price, then this will line up with your outlook, right? That would look like, okay, that's how I feel that there's a very good chance that it's going to go up. And if it goes down, I want to be stopped out because at that point, something must have gone wrong or the market's going to collapse or whatever it is. So now we could visually see this is, let's say, we like this risk reward ratio. This lines up with our outlook. So let's say we're all good there, right? Let's say that this looks great to us from the initial analysis. What else can we do? Well, let's take a look at if we're receiving enough credit, right? Is this a good amount of credit for this type of strategy, for this risk that we're taking in this specific stock? And how do we do that? So we need some benchmarks here, right? We need to have some perceived fair value. Or are we selling this, even though it looks good? In theory, are we selling this at a good price? Because just by looking at it, it may seem good, but we're not sure because the stock can behave in certain ways historically where this might not be enough. right? So that's the next part of analysis. Are we getting a decent, are we selling this for a good price or not? Right? Like imagine if you're, you might go out and you find a great piece of investment, real estate property, commercial property, and it looks great to you, and you're like, this is exactly what I want. But then you want to appraise it and say, well, am I overpaying for it? Am I getting a fair value? Am I getting a little bit of a discount that gives me some cushion there to take on that risk? Or should I wait or look for alternative investments? And that's what we're going to do next. Say, well, how do we evaluate that to see, are we getting enough of a credit? Are we selling it for enough of a price? So there's no one way to do it. We're going to have to start looking at it, from different angles using different models, right? So the first one that we're going to go to is this distribution theory. And what it will do is say, based on how the stock historically moves, right? How does Palantir historically, over 36 trading days, right? How does Palantir move? And based on that behavior, what do we think the fair value average price of this spread should be, right? If we just use that. So that's what we're going to go first. So we'll go to the distribution theo, and we're going to say, okay, based on 4 years of data and using the implied volatility range that we're in today, so this is a dynamic, right? Using 4 years of data, so what do we think the average end value of this particular spread, right, would be? So here we see that we're at $1.62, right? So on the surface, that looks like, well, we're selling it for $1.31, but based on history, 4 years of history over the stretch we had, we only had 9 observations, right? So in 4 years, because you're talking about almost 2 months, right? We had nine observations there, but the end value was $1.62. So selling at $1.31, we got to feel very confident, because what are we doing is paying an extra fee almost based on that perceived theoretical value, that we're willing to go down to $1.31. You have to feel much more confident in your outlook, right? In what you're doing. But let's take a look at it from a couple more perspectives. What if I just took it and said, give me all the results, no matter where the implied vol is, change that, or rerun that. So that didn't really change anything. We could expand it a couple years, and see if that didn't do anything either. Oh, well, Palantir, I don't know if let's come in a little bit. So in the last 2 years, it looks like if we use last 2 years of data, perhaps, it was not as volatile. Maybe it had more up moves and down moves, but there it looks like it's about $1.39. Let me do 1 years of data, 79 cents. So you could see here that, but there are only 2 observations here. So you could see that in this, right, and we're not expecting earnings coming up. So you could see that in this analysis, it's difficult to really say, well, which numbers if in the last year, it looks like, yeah, that this would, the 2 observations that we had, because remember, we had to take out data where there's earnings and so forth. In the last year, out of the 2 observations that we had, on that, the average value is 79 cents. It's not that many observations, but that's all we have, right? If we expanded it 2 years, we had 5 observations. Remember, this is already cleaning the data for us, because it has to take out dates that covered an earnings period. So we're talking about 2 months. That's, you have to remove a lot of data from there the covered earnings periods. So that's $1.39. Again, you're taking all of this into consideration. There's no, sometimes people ask me, well, which one do you use? You're looking at all of them and taking them into consideration in your analysis, right? Because all this data is relevant in a different way. You're just looking at it from different angles. So that's one way to look at it, that if we looked at a longer history, it looks like that it's priced right now on the lower end. If we look at the shorter term shorter term data, shorter term history, it looks like maybe it's more fairly priced. Let's go to another analysis. Okay, so that's just using historical return distributions, the way the stock actually moved. All right, based on how the stock moved in that period. If we move to over here, another way we could analyze it is how irrelevant of where the stock moved, right? Irrelevant of where this stock tended to move in that period. If we looked at history and said, if we found a similar situation, where Palantir had 36 trading days left, right? If we found a similar situation in history and we looked at the options, the premiums in the options, and we could see here that, each option has an implied volatility, and these two options have some relationship as well. A skew, right? They have a skew and some kind of relationship. And the skew has boundaries, right? You can't, the skew can't get way out of whack, because then you'll have an arbitrage opportunity, right? So they have a relationship. That sometimes the implied volatilities can come very close together. They could spread apart. And what we're going to do is say, okay, if we looked at history and we took snapshots of similar situations in Palantir, what is the usual value of this spread, right? Not the end value like we just did based on how the stock moved, but just the usual pricing of options, right? Based on where do the options usually get priced in this similar situation, not knowing what's going to happen. So think of it as like, we don't know what the result of a football game is until it's actually played, right? But when these two teams play, what are the usual odds that the casinos give? Right? Is there one team favored by a certain amount before the game? That's what we're looking at. So how are these options usually priced versus each other? The spread. That's the question. So if we went back 4 years of history, right, and looked at the snapshot. So down here, we're going to look back in history on our options chains for options with 36 trading days to go. One of the options is 4.8% above spot. One is below 10.9% below spot, right? We're gonna go do those calculations, and then we came out with the implied volatilities, and based on those, we are going to calculate what would these options be priced today. All right, what would these prices be? So you could see here, right now, the spread would give you a credit of $1.31. If we took the average of all those spreads, right, going back in time, if we took the average, we see that the average is a credit of $1.34. So we're pretty close, right? We're not a little bit below, we're pretty close to that mean, right, to the average. What about the range, right? How we see that the average is $1.34, but what about the high and low range? Right. So when we look at the stats, right, we start looking at averages, means, medians, low, high. So what about that range? So we could see that it got as low as $1.27, as high as $1.48, right? And this is using the dynamic IB. So this is looking at when the implied volatilities in general were close to where we are today. All right, let's expand that now. Let's look at all results. So if we expanded and said we don't care if the implied volatilities are on the low end or on the high end, we don't. Let's look at all the observations. Right. So now we expanded our the number of observations to include the implied volatility. No matter what it is, we're going to include them in there. So here the average went up, right? So we had implied vols maybe that were higher or whatever, skewed things up. So now the average is $1.41, with the low $1.27, the high of $1.87. So you could see here that that spread right now is a little bit below the average, right? Now, one thing though to consider is that when these observations look at, and maybe I'll even change this, but we are heading into a slower period, right? We're heading into November. Remember, we talked about November, December. Let's take a look at that. I'm just going to show you guys really quickly. So this is volatility seasonality. So you could see here, we are right here in November at the end. So like kind of, vols come in, but hold on, let me just see. This is, right. So this is the stock volatility, right? And then the volatility starts to go down, as we head towards New Year. So this is typical of the market, as long as, obviously if you have earnings or something, that'll change it. But usually, typically, that's what the seasonality looks like as we go from the end of November, like kind of starting right around Thanksgiving. We have more holidays coming up. People are less aggressive establishing positions. Volatility tends to start to decline as we move closer and closer and closer to that new year. All right, so that also, even though we looked at all that data, that's another data point reference that you want to consider, that that historically, seasonally, the volatility in the market started to decline.
AD, that was some great information. Actually, you got a nice comment from Wes, who said, I just want to thank Dimitri for helping me learn all about options. I'm just a baby right now. But that was a nice comment. Rob did have a question about this. He said, Will, is the comparison of unusual pricing versus today the way to get edge in options pricing? Maybe we can look at that tomorrow. Rob, maybe you want to talk about it a little bit more. I'm not quite sure about the question. D, I don't know if you are, but he's asking, Will, is the comparison of unusual pricing versus today the way to get edge in options pricing? Maybe we'll leave it as something for tomorrow.
Okay.
How's that?
Yeah, let's leave it for tomorrow. Maybe show us like what you're looking.
Yeah, Rob, if you could come on tomorrow and show us what you're looking at, that would be super helpful. Actually, we did miss Michael second day in a row. He asked a question. He was asking about setting up a watch list exclusively for tickers you want to be alerted on. And maybe that's
Okay.
something we can talk about tomorrow too.
Okay.
All right. Awesome job, D. Thank you so much.
All right. Thanks everyone for joining. Stay safe out there. Have a great trading day.